Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic gauging the market mood. All of us tend to look at flows. If you are an experienced investor or a fund manager or even higher, say a CIO, what bothers you is in which direction money is flowing, because if money flows consistently in one direction, then you can't be caught doing things in the other direction. So everybody is watching flows very closely. Flows also have a tendency to confuse us. For example, while we see that domestic investors were unwilling to invest aggressively in the first few months of this year, we are seeing a change in that in March, which is a very unusual phenomenon. We are seeing mutual funds get very strong flows in March. Usually, you all know that March is that time when you have to pay your taxes and people don't have that much of flexibility. But this March seems to be quite different because flows seem to be very strong from domestic investors. And that is happening into equities. Clearly, this Russian situation in Ukraine has been bought into aggressively in mutual funds by retail. Now, whether this money goes into those parts of the market where value is very strong and the immediate prospects look reasonable, or they have gone into the expensive parts of the market where value is surely not in favor, but there is a bias which makes managers buy only those parts. That's an issue which we need to look closer. But my sense is that both have happened, but more of buying into expensive stocks has probably happened on the institutional side. This is because mutual fund buying is oriented towards a thought process. It doesn't turn fast. Investors are fixated on the same products, and they will keep on buying those products whenever they think the index is down or the markets are giving an opportunity. But there is a lesson to take out of history and past experience. When you are seeing a curated product invest continuously in the wrong valuation zone, they are probably going to time correct, test the patience of the investors, and eventually not deliver. That's the history. So, blindly buying the same parts of the market which you bought in 2020, which seemed to work in 2020, has not worked in 2021. Again, in 2022, taking chances in the same part doesn't make too much sense to me. But that's exactly what I believe is happening in the markets in the mutual fund space. Essentially, somebody who invests on his own needs to have some method, and his method is going back to the same products. The constant din in his ears that just stick to what you are doing and you will be right has made him believe that this will happen. But if you look at the history, it has not happened that way, because for very long periods of time, certain schools of investing have not delivered. And then they have started delivering negative returns. And then they turn around and deliver positive returns. Now, if you are invested at a time when they are not doing anything, then you are up against a time when they start losing. And only after that they would start winning. Now, it remains to be seen if investors are going to stay in this long journey, because I believe it's going to take a very long time. On the other hand, the market is turning, and we are going to see the attention of investors move towards a new place. Astute money will chase future opportunity, but regular money is chasing past opportunity. Now, if you are an investor who wants to do your mutual fund investing better, I think you must move from the ordinary to the astute. Shift from what you did regularly to do something differently. This is a time when you need to invest, but you need to invest exactly where the market will deliver in the next year. What happened in 2020 is you were invested exactly where the market delivered, And that was a certain economic context where a certain philosophy worked. In the current and the future economic context, that philosophy is probably not going to fire. It's going to take a long while to fire, and you need to decide whether you have a better alternative. After all, you need to make a smoother investment journey, and changing your choices will probably make your journey much better. That is an individual call, whether you're doing it yourself or through an advisor. You need to ask that question. But overall, the mood seems to be to buy aggressively into opportunities, buying into bad news, buying into dips, and making every opportunity count. I hope that investors who have this kind of a discipline and conviction in equity as an asset class sharpen the choices so that that conviction translates into outcomes. After all, you deserve it for showing conviction when there is fear all around you. So make your choices better, make them futuristic, and make your investing succeed. Thank you for watching this video.